Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel. It's our final live class of this Tuesday, Building a Stock Portfolio. And I'm your host, Kevin Horner. I'm joining you from our Denver studios and pleased to be with you all today. In my pre-work, I noted that we did not have any exit trades this last week. So we once again maintain a portfolio and we'll be able, an example portfolio that is, and we'll look to raise some stop orders along the way today, while also hoping to add a couple of new positions first thing tomorrow and check those out next week with you as well. Today, joined by my friend Michael Fairborn there in the chat. Say hey to Mike. He'll get to comments and questions that I'm unable to address live and during the session, but don't feel compelled to not post in there. Of course, I want to hear from you, and I'll keep an eye on what's going on in the chat as we work through each individual chart we hit today. But I'm going to try and bring pertinent questions to the table where I can. So happy to hear from you. Don't hesitate to post for the duration of the show. And if you're not already doing so, you can find Mike and me available on X, Mike Fairborn CS, Kevin Horner CS. We do try to post for you throughout the week, give you some interesting charts. In my case, I often provide a chart, and then maybe days or weeks out down the road, you might see a follow-up chart just to kind of continue the discussion of the existing trends that might be working for some of these positions and trades. And so if you're looking for that kind of thing, X is a great spot to find Mike and me. I'm also there on LinkedIn as well, though admittedly not as active on LinkedIn as I ought to be, but I'm going to try and kick that up a notch for y'all. Now, today we will do a brief market review before we get to the example portfolio to make some necessary changes along the way, discuss those individual trades, and some of those will not require changes. And then we're going to look at adding 2 new positions in the example portfolio. So with that, let's get to disclosures and then we'll dive in. So please remember, everything we cover here is informational and educational only. We do not make recommendations. What we offer up is education of technical analysis as it relates to the broader markets and some of these individual trade examples. But technical analysis is just one of our decision-making puzzle pieces. It is not the entirety of it. So please do not make decisions only off what you see in the way of technical analysis. All right, so I said we're going to start with a quick review, and it will be quick. The market hasn't given us, now today was a little bit volatile, the last week even a little bit volatile, but really we haven't seen anything in the S&P, in the NASDAQ 100, or even the Russell 2000 that changes trend. The most notable recent move, I think, for many traders is this beautiful hammer candle off of support at the 50-day moving average, giving us once again a higher low. We do have a broken downtrend line, and we have maintained and been above that each of our last sessions over the past 2 weeks or so. So you've got a few areas for trend monitoring. At this point, obviously, we're looking and going forward with the belief that bulls could target the prior highs in the neighborhood of 76.10 is our all-time high close, or 76.09 and some change. So we're looking at that level up above. Getting through that would certainly be considered bullish, as we know new highs are not bearish. For many traders, though, monitoring this trend, they're going to want to see the hold of the 50-day moving average right there in purple. And if not that level, we're going to call out the last lows, essentially, which was, the last low was really right here, right? But if we're going to look at lows that are all in a close vicinity, this zone seems to be the one. Now, remember, we can get action into that zone of potential support with a hammer like this and this lengthy tail, which tells us the bulls stepped in and supported at that price. So if we get intraday movement through those levels, that's okay. What we want to see is, do we close above those levels? And so we're a ways away from that, but as always, I want to give you a few different areas and price ranges to monitor. So that's one of 2 of them, actually, the 50-day and then our last lows. It's going to look similar in the NDX, though the NDX has been a little bit less ready to break out, because as you can see, we've got this downtrend line we haven't traded above yet. We do have the same beautiful hammer candle, except it happened at horizontal support, not at the trend line, the moving average, the 50-day. Today we're at the 50-day, kind of got one of those indecision dojis. And I think a lot of traders would agree with me when I say that this is likely the reflection of the heavy technology allocation to the NASDAQ 100 compared to the S&P 500, which of course has a much broader allocation, though the largest components are in fact technology. You just got a lot more opportunity in sectors that the NDX does not. So that's one of the things you're getting out of the NASDAQ, a little bit tighter range as we're trying to figure the tech trade out at this moment. And then our small caps have been under a little bit of pressure, but that pressure is likely tied to the fact that we've witnessed the 10-year yield staying a little bit elevated. I'll remind you all, though, that the 20-day has been violated before, and those instances were your opportunities. Here you had 2 or 3 days below it. Here we had about 3 or 4 days. They were a little less easy to determine here. And then we, of course, are below it right now. And so we're going to figure out, is this one of those situations where we need to see a pullback to the 50-day? We really haven't tested it, although the low back here in early June was pretty close to the 50-day. So from a trend management standpoint, some traders may have lightened up in the Russell by virtue of the closes beneath the 20-day. Some would have said, you know what, I'm not going to lighten up until we close below the 50-day, which has not occurred since we recaptured it back here in April 8, with the rest of the broad market getting that nice gap day. It was a gap day that led all 3 major indices above the 50-day moving averages nicely. So that is notable that they've all kind of been trading in concert with one another outside of the most recent price action, as we've noted the S&P and the NASDAQ kind of being into consolidation windows. All right, so there's your brief look at the broad market. We'll expand that a little further tomorrow morning for those of you wondering in our Trader Talk class, which kicks off at market open with the opening bell. I will be on with Brent Moores tomorrow morning, and we will certainly expand further on the macro view of what's going on here. Now, that said, it's time to take a look at our current account portfolio, our example portfolio that we have been building. We've been working to maintain these positions along the way. First, I'm going to highlight the portfolio breakdown. I have it built into a building a stock portfolio model, if you will, that is separating these investments amongst their individual sectors. Now, one thing to keep in mind as a trader, you may want to press at certain times in the year. You might be comfortable being in 1 or 2 sectors, and that would be okay if it meets your tolerance for risk. But the key to remember is if you're only in 1 or 2 sectors, just like if you are only in 1 or 2 stocks, well, then your movement on a day-to-day basis is going to be exclusively tied to those 2 sectors or those 2 individual securities. So what we're trying to do now is expand out a little further so that we have allocations that will do well on certain days. So we have some positions performing well when the market's in pullback mode, like our defensives, like perhaps staples and healthcare, and then maybe industrials even, which those 3 have been very positive of late, as they have in many cases broken recent downtrends, trading to new highs, short-term uptrends in play. And what we want to do is get a little bit more balance from the portfolio, and that makes it a little easier to manage a trading portfolio too. Just as though you were managing a long-term portfolio and diversifying through asset allocation rather than through individual stock positions, right? You're just exposing money to these groups, sectors, industries in the marketplace. But a lot of traders go forward with the idea that if I'm simply buying stocks for trading and managing with X strategies along the way, that I don't need to be thinking about diversifying it. And I disagree with that. I actually think it makes a lot of sense to try and diversify your approach. So even if you're in an individual space like health technology, let's say. Some traders in technology want only semiconductors. Well, that leaves you with pretty good amount of risk, right? But if you expanded and said, well, I'd like a little bit of hardware, I'd like some software, I'd like some memory, and that definitely some semiconductors. Well, now, even within technology, at least you have some groups that might not move in concert with one another. One day you might notice semiconductors doing well while the software is getting beaten up, right? And vice versa. So diversifying your process a little bit will help us. Now, last week, we added a brand new position to our portfolio, our example portfolio here. It was the Industrials RSG. I'm going to lead us with that one just because there's not going to be many changes or concerns here. What you'll notice is that I have our entrance for a stop. I could put our trades back in. Let's go ahead to my gear icon. We'll put a little check mark in the show trades here. And then we'll be able to see we bought at 221.51 last week. And we are in it with a stop below the 200 period moving average. And we are below that by the amount of the average true range. So today, the 200 day comes in at 215, it looks like. And we are currently at 213.69. And our average true range down here is at $4.71. So we are in a proper area for that stop. And actually, now that I think about it, I believe what we did was we went and built our exit not based on the moving average, but rather the lows that we have seen since the stock broke out. And I was calling this move here basically our highest close. I was more or less looking at the lows since we took this out. So basically did that math. It's below right now the 200 and the 20 period moving averages. So the fact that we're below both of those, it does give us a little bit of wiggle room. We will not make changes to the RSG trade at this moment. We've only been in it 6 sessions, or 6 days. So we're going to go with it and see if we can't hold in here. But I'm encouraged because the position has, even though we're in it, and it hasn't rallied aggressively. It didn't hold the high it made yesterday, for example. There's a little bit of resistance up there. I'm encouraged by what we're seeing here nonetheless. And we don't want to make a change to raise our stop just yet. We haven't had enough movement really to verify or to validate this move. So we'll go forward for now, maintaining our current stop. But next week, if this trades higher than the 224 area, we're going to get the opportunity to elevate our stop order. Okay, let's go with our Dell trade. Dell has been fantastic for us. A couple of things to point out here. We are in at 409.99. We got in on this day, on the 17th. And here we trade at 457. So we're looking at about 40 points of upside. And we're going to use that 20-period simple moving average. Last week, we made no adjustment because we were still in this consolidation phase. Now, since then, what we've seen is a break of our downtrend line, and today we're basically the highest close since the day we made our all-time high. So that's a positive for us, and we've got the 20-period moving average getting tested just yesterday. So we could take yesterday's test as a validation of the 20-day as short-term support. So if we look at the 20-day today, it's 421.40. We will take that amount less the amount of the ATR beneath us, $30.28. And that gives us a new price at 391.12. And I have to update this. All of my pre-work, unfortunately, gets thrown out the window once I have closing values. So 391.12 is where our new stop needs to reside. Now, our existing stop is at 374.87. So we're going to elevate this stop quite a bit. But notice when I push it up here, everybody, where it resides, it's going to basically be close to those last lows that we made. So I said 391.12. We got to go a little lower here. This is 21. So I'm going to edit that. All right, so we're going to go with that 391.12. Hit confirm. Just make sure we're replacing the order. Yep. So we are going, the one thing we can't say, unfortunately, is that we've locked in any additional profits simply because this is a market order once it becomes triggered. But look at the level that we are sitting on. Basically, we'd have to come back and test those same lows. That does put us at a little bit of risk for getting stopped out because a break below the 20-day that found support in these last lows, it's a good, better chance of getting stopped out. But by the same token, the fact that we are above the downtrend line here and having recently tested the 20-day, a lot of traders would tell you that our path of least resistance at this moment is perhaps more to the upside than the downside. We know that that's just probabilities. That doesn't mean it's going to play out that way. But if the probabilities favor bullishness, well, then we're going to take the view that there is bullishness here, and we're okay raising our stop. If that level is a little uncomfortable for you, that's fine. You could always go a little bit lower, or you might even go in right beneath the most obvious low of the last, say, month of sessions here, and that might be the low on June 29. That stands out a little bit as well. And then lastly, some of you traders might want to work instead of with the 20-day, your time frame might be longer, and maybe you're comfortable with the 50-day, but recognize, hey, that's a lot of dollar per share risk we're talking about. A big difference between our stop at 391 and the 50-day at 354. And remember, in many cases, you're not using the 50-day, but rather an ATR beneath the 50-day, which would basically put you in the neighborhood of about 320. So you'd be looking at about 100 points of risk from where we are on the 20-day moving average. So just a reminder of process more so than anything else. All right, so there's our Dell. We've made an adjustment. Let us check on our Dollar Tree in the staples space. So we have a bracket order working here, everybody. We are long at 109.96. We've got a stop in at 111.24. So we have a decent chance of, if stopped out right now, we would still be better than break even. That's a good, comfortable feeling, even though we can't guarantee it. But the price in the 20-day has risen aggressively, so we are going to make a change here to our stop. Now, notice it is bracketed, so if we do get up to 135, we're going to sell up there, right? But only one side of these can execute. So we're either going to sell at 135 up there, or our 75 are going to get sold at a stop. We're going to use the 20-day at 119.19 less the ATR of 448 down below, and that gives us 114.71. So we can just click and drag this up, or we can cancel replace, and we're just going to cancel replace just the order, which is the stop, not the limit, because our limit order is set up there. And again, we're changing this to 114.71. And I'll remind you, we like to avoid zeros and fives when we're placing stops because it increases our chance that we're not following the herd mentality, right? It's very easy, human nature, to lean into zeros and nickels when setting these levels, and we go off of those. In fact, some traders would want to go beneath whatever number we set by 2, 3, 4 additional pennies just to give a little extra wiggle room. But that is your call, everybody. So we're just going to make the adjustment here. It stays good till canceled. We are raising it up to 114.71, and that looks good. All right, and then again, just notice how nicely far beneath the 20-day that resides. It's a pretty good amount, right? So we would have to really violate the 20-day to get kicked out here. And that's ultimately the exact reason we are utilizing ATR as our method for determining our exit strategies. I'm going to open up the scratch pad here just to give you some reminders of the process we try to follow here. Okay, next up, let's move to EW Edwards. So this is kind of notable. We've got our 50 share order. So what we did here, everybody, just a quick revisit, we bought at support 78.61. We rallied into resistance. We took 50 shares off at resistance, and then we set our stop on the remaining 50. So we took profits on 50, and our goal was to stick with the remaining shares for as long as possible. Well, it's continued to work for us pretty well. Now, today, zooming in even further, look at that hammer candle. So, yeah, we opened well below the 20, traded all the way down to today's intraday low, 88.20. We are currently in a stop at 86.50. It's below the 50-day. There's no reason for us to necessarily make a change here. We could, if we wanted, make a change. In fact, if you're the trader who was looking to make a change, let me give an example as to when it might make more sense. Today it's a little early, okay? But if tomorrow we get a follow-through day to today's hammer, if we opened above the 20 and closed above the 20 with a candle that resembles anything mostly green, kind of like this, or even ideally like one of these, like this big, beautiful one where it's filled in all the way, and we traded and closed at the high of the day, which would be well above today's high. Well, then we would have potentially a close above the high of the low day following a pretty decent pullback to the 20-day after making new highs. That would be an excellent reason for a trader to give consideration to then raising their stop. It's just in our case, it's not yet ideal. So we're going to kick the can another week. And maybe a week from today, we look at this and EW is trading maybe close to new highs or has made new all-time highs. Then we will be happily raising and elevating the stop thereafter. For now, we're going to stick with it. Let's see if we can't maintain it. But the good news is, even in the scenario in which we get stopped out, barring a complete terrible gap lower maneuver, the odds favor us being in a profitable trade based on us taking out the profits up here already. So we can't guarantee that. We know it, right? We have gap risk with our stop orders, but I thought it was pertinent just to remind us that we've done a decent job managing this one thus far. Okay, how about next? Let's go to Marvell. We just added Marvell here, so it's been 2 weeks. We were looking originally at Marvell as kind of holding into this lovely gap level, and then all of this broad market weakness has come in over the last week plus. But interestingly enough, look at where we are. We are at a stop of 214.86. What was our low yesterday? 215.28. We missed it by about 40 cents. Today, the low 218.63, a little bit higher. So we are close to being stopped out. It's important that the stock doesn't trade lower. Obviously, come tomorrow morning, we are at risk of being stopped out. But this is a prime example of not stock-specific news going lower, but broader market news or even pure relative news bringing the stock below its 50-day moving average. It has sold down, but not so much so that we've been stopped out just yet. We've been using the 50-day for validation, I believe, or maybe we used the 20 on this. Actually, we used this when we built Marvell, we used the lows of the move since the gap higher, which was at following earnings, this big gap, and we basically used this ledge approximation and then went below it by the amount of our ATR. The point at this time now, no changes to make, right? Because we have our stop, we're at risk, but we also know that while we're at risk of being stopped out here in Marvell, we took a proper position size, so we know that even if we get stopped out, our odds favor us not losing more than the tolerance we have for that trade. So we'll stick there for now as well. All right. Recent addition was Morgan Stanley. Financials have been doing wonderfully. In fact, look at Morgan Stanley traded intraday today to a new 52-week high, if I'm not mistaken. That might actually be, new all-time highs. Look at that beautiful chart. Wow. Just some consistency of movement here, right? Looks like a pretty deep cup and handle. Down, there's your cup. And then you have this maneuver into the handle and we took out the handle in May, June, right here. It was mid-May actually, and we've just been rallying since. We have managed this one well. We bought 40 in the consolidation window, took 10 off when we got up to this new high, and then it pulled back. Now, we did not add back any of what we took off, so we need to raise our stop on this one, and we're looking at the 20-day because we're right back above the 20 now, having made that move, that push. So the 20 here is 219.75, and our ATR is 622. So 622 from 219.75 gives us 213.53. So we're just going to push our stop up to that approximation. So 213.53. So this one is a big adjustment for us, as you can see. And again, when you're doing the click and drag functionality, you're not going to get it right to the penny that you want. Here we're at 213.49. That's off of the zero, off the nickel, and below the price that the math that I did. So we'll go with it. We'll stick with the 213.49. Go ahead and hit send on that. And now we've got those 30 shares relatively protected. But again, when you look at that, while we know we can't guarantee it, we're looking at about a $24 upside opportunity on those 30 shares after having taken $25 off the table on a 25% position, 25% of that position. So, we've already taken a little bit of profit. That might give some of you reasons to be a little more wide in your reasonable exit strategy, your stop order. Maybe you want that stop below the 50-day. This is a good reminder of horizontal support being below the 50-day there as well. Some of you might build an exit beneath that level, incorporating the ATR, which would put you down just in the neighborhood of 199. And even that would be a good opportunity to remain in profits on this trade. So I hope what you're taking away here is not that my process is the process, but rather there are many ways to go about this, and each of these levels that you see can in fact be an exit strategy. Remember, it doesn't have to be as black or white as even I've made it here on my 30 shares in Morgan Stanley. What if we wanted, we could do maybe only 10 or 15 at this price and then do the remainder an ATR below the 50-day. You can layer these exits as well. There's absolutely nothing to stop you from having those various layered exits. You can go about this any way you want, whatever gives you the greatest amount of comfort. I'm a believer that you can do it I think a lot of traders lean into the idea that you can do it in about 2 or 3 steps, whether that's entrance or exit. I think if you get beyond that and you're suddenly using 5 different levels, 6, 7, 10 different levels. If you have a large enough position size, perfect. It makes a lot of sense. You can absolutely do it that way. But for some of us, it's just as easy to go with 2 or 3 and then just piece out the position over those 2 or 3 levels and be just fine. But whatever gives you comfort is really what I want to encourage you to do. Okay, we talked about that RSG trade. We put that one on recently. We status quo there. Zebra, we did just add. Let's look at this chart. This one we bought in based on a potential expectation of a new trend coming into play here. We've had 1 chance above the 200, 2 chances above the 200, 3, but now we are in what is clearly a different scenario, right? We are about 2 weeks above the 200-day moving average in here. So we do have some opportunities with Zebra. Now, the stock has moved up higher since we acquired it a little bit. But more important than anything is the 50-day moving average and the 20-day moving average have both been rising quite significantly here. So in this instance, because our stop on the 20 shares is down there at 231.08, let's go with the 50-day, which is the lowest of those 3 major moving averages. Some of you want the 200, some would prefer the 20. Take your pick. But the 50-day, if violated and broken by an ATR, that would pretty much signal the the short-term uptrend having run its course, and then we wouldn't want to be in this trade any longer because then it would look like a rejection. And if it looks like a rejection, well, then we don't want to be in it, right? Now, right now, it has the makeup of something a little bit different, which is why we're looking at it, okay? So it looks like a broken downtrend, but it should not shock us at all to come back and test that broken downtrend line. Remember, it was resistance here, resistance here, resistance here, resistance here. What once was resistance can then offer support. So this is a wonderful spot based on a confluence of data. So we'll take 245.91 less the ATR of 1058. And now we have an ATR of a stop level of 235.33. And we're currently in at 231.08. So we'll just cancel replace 235.33. Whoops. 33, not 44. There we go. All right. So there we are, everybody. We have made our necessary adjustments to the existing example portfolio. How about some new ideas? So I went forward with the idea that we should once again look in staples. I found one interesting position, and that is Kraft Heinz. Kind of similar to what we just saw in our last position there on Zebra is a change of trend. What do we have? This is a long-term, let's make this a 2-year chart. Check this out. Look at that. The peak back here in October of 24. Pretty clear downtrend until all of a sudden it wasn't, right? What I just got done saying about resistance becoming support. Well, we know that white line is a formerly resistant white line, but here kind of acted as support. Didn't stop the selling. I want to point this out. It did not stop the selling, right? But when we take a look, we made even more moves, but always testing that same line. Now, off of this move, we've been able to recapture the 200-day. And so we've got a very interesting development here in Heinz. Now, we've got a 20 crossing the 200 to the upside. We've already had the 20 crossing the 50-day, and the 50-day is catching up rather quickly to catching the 200. So we're about to get that crossover as well. So we're looking at a dramatically improving trend here. Downtrend becoming the potential for an uptrend. So most likely, a trader is going to find the greatest amount of comfort in leaning into those moving averages. And again, the 50-day is our lowest moving average. So let us talk about the potential entrance at, say, 25.50. Okay, reminding us that if we said let's buy at a limit of 25.50, anything under 25.50 is going to give us execution. Remember, it's always this price or better. When we're buying or better, that means less. So even if it opened less, that's fine, but we want to give it enough wiggle room to get us into the trade. And then we need to incorporate that cost, that potential cost, with our exit strategy. So our 50-day is 23.68 and our ATR is 71 cents. And so we would be looking at 22.97 for a potential stop. If we are in our trade at 25.50 and put in a stop at 22.97, well, then we are risking $2.53 per share. And our max comfort for a loss is $1,000. So I'm going to take $1,000 and divide it by 2.53, and we can own as many as 395 shares with that math. Now, if we did buy 395 at 25.50, which is our absolute highest cost, well, then we would exceed our comfort zone, everybody. That would cost us more than $10,000. So we can't buy 395. we need to come up with an amount under that that would be comfortable for us. And so generally speaking, anything close to 350 would be fine. Some of you like round figures. I fall into that vein as well. But let's go with an approximate of 200, which will at least get us a trade that's not too big for our portfolio. And it also won't exceed our tolerance for risk in all likelihood. It doesn't guarantee it, as you know, but it does give us a better setup. So let's go for 200 shares at a stop of 22.97, but a buy order at 25.50 or better. Now, I'm going to pose a question for y'all as I get this set up. Do you want to work with this as a bracket? Do you want to target an exit price above us, which we can certainly do? As I see it, it would be piece of cake just to build in an exit strategy with just a stop order. But if I was to pick an area above us that might make sense, an initial area of potential resistance is right about here, close to 28, catching these prior highs right in here. Okay, so that's a potential zone. We could target 28, but that'd be about $2.50 of upside, maybe as much as $3 of upside. And that would be about a 10% position. So we could certainly do that. So Jay, you like the idea of bracketing this rather than just the stop order. That's cool. I think 28 would be a reasonable target in the short run. So we can do that. Why don't we build it with a target as well as a stop exit? So we'll do that here with a right click. And remember, everybody, if you know the price in advance, when you put your crosshairs to it, you can really limit your effort here. I'm at 25.52. If I right click, buy custom with OCO bracket, look at where my limit is, right at 25.52. So now I can just go, all right, I didn't want to spend 52. I want to spend 25.50 or less. We'll make that good till canceled for the next few sessions at least. And then again, our exit 28, but actually, here's what we'll do. We're going to do two separate buys such that we want to, if we get taken out on 100 up above, that's great. So we'll bracket 100 entirely, and then we'll add a second without a bracket. This way we don't have to worry about losing our stop order if we get taken out at our limit up above. So we're going to place two buys, one fully bracketed, one with just a stop, but all the levels will remain the same. So here we've got an exit that would be good till canceled at 28, or a good till canceled stop exit at our 22.97. Now we're going to try and make this as easy as possible, right? So I'm going to place this, buy 100, sell 100. Only one of those sides can execute, excuse me. So we'll just confirm that. Buying 100, selling 100, selling 100. Great. All right. Now we can go back to our account statement page, go to order history, and that one we just placed, we can just create duplicate right here. So now I create a duplicate order to buy. Oops, that's the sell. Hang on. We want to go this side. Create duplicate. No, that's not what I want. I got to pick the right one here, everybody. Sorry. Create duplicate on our purchase. There we go. All right. And then, well, it's not going to add in my bracket. So we're going to go delete that. We're going to go back as I intended. We'll just do this once more. Right click, buy custom, this one with just the stop. So here, limit is 25.50, good till canceled. Good till canceled, traditional stop. 22.97, again, that triggers, becomes a market order to sell. So this way, everyone, if we get up there to 28, we sell 100, keep 100, and we've got the stop order remaining, and then hopefully we get as a chance to raise that stop into the future here. All right. So, Jeff, your question is one triggers all the same as the OCO order? Yes, except that in the one cancels the other. In this instance, one cancels the other means we can only have one side of that trade go off for us, right? So in the instance that we place it as a buy of 200 shares and desire to sell 100 at a limit and then a stop on the full position, once we sell 100 shares at our limit, well, now we only have 100. And so the system says we've got to cancel out that remaining stop. My hope is that in this process, by entering two separate orders, now we have an exit that won't get the stop order removed, so we won't have that protective measure taken away from us, which is why we did that. Hopefully that answers the question. So I do want to answer this as well, though. Relative to stop orders are only good, as we set them here, they are only good for your live regular session. That is 9:30 a.m. to 4 p.m. Eastern, Monday through Friday, most weeks. No pre-market, no after-hour sessions. Okay? All right. And then the last one, we're not going to have time for today, but I wanted to bring it up and just highlight, we were talking about maybe adding utilities. So I went and did my same scan, which is uptrending all time frames, but I utilized utilities. And the interesting thing on Nextera was the movement recently above the 200-day moving average, and then today moving above the 50-day. So my plan, at least, was to look at the 50-day and build an order, and excuse me, looking at the 200-day, not the 50-day, I apologize, the 200-day at 87.13, incorporating the ATR beneath that, and giving us some exposure to utilities that I don't currently have. Unfortunately, we're not going to have the time to do just that, but I wanted to point out why. So when you look at the Market Watch tab and the sector tool that gives me the visual of year-to-date performance, we've had a recent bump in energy with oil rallying this last week plus. And notice, though, everything is in the green on a year-to-date basis, everyone. The only thing not is currently discretionary. It's off by a little more than 0.25%, a little less than 1/3, right? But utilities are even up 5.7%. So if you're looking for ways to reduce the volatility of your portfolio, this is one good consideration. Make sure that you have some individual trades in as many of these sectors as you can justify. Okay, you're not going to be able to justify all of them, and you might not even find stock that you like. And especially when you're looking at utilities, we have to look at what is the stock offering us. And remember, utilities are often going to pay you dividends. So you want to consider the dividend payout. You want to consider whether you want those dividends to be reinvested for you or paid only in cash. And be considerate that if you're investing for the dividend and the company changes that dividend, then it might change your willingness to stick with the company, right? A friend of mine back in the day used to say, as a dividend investor, if they cut that dividend, they're dead to me. Then I'm moving on, because the whole purpose for the purchase was based on a dividend and or trend. If the dividend is part of your return and that gets cut, well, then you might want to make a change or a decision. Remember, any dividend, it's not a guarantee to be paid, right? The company does not have to pay it. Now, there are some that are very good at it and they pay it consistently for 25 years or consistently for 50 years. Those companies could certainly give you a little more comfort maybe. But if a company you bought for a dividend cuts it, it's not uncommon to want to move on from such a decision. So I wanted to bring that up. You know, utilities are a little bit different than a standard trade process, so just be aware of that as well. Okay, yeah, we're at time, everybody. So we made some changes here. We got you a quick market review. We went through and updated our example portfolio, and then we're looking to add Kraft Heinz to the mix with hopefully tomorrow morning the open trade coming in better than 25 and a half, and we'll see how that one manages for us. But it's going to give us what we hope is a little extra added exposure to the staples space. Our Dollar Tree, did we talk about Dollar Tree? We talked about Dollar Tree, right? I hope we did, because I'm just now getting this. Let me just take a quick look. Did we even look at that one? Yeah, we did. Okay. Some days I wonder what is going on. Other days I'm feeling pretty good. But at the end of my morning, end of my whole day here now, you're catching me at the wrap up time. So, all right, big thanks, Mr. Michael Fairborn, there in the chat. Always appreciate hearing from all of you. Thanks for joining. Remember, you can watch this class in the archive at any time. This one will get reviewed, probably have you at the top of the list come tomorrow morning. And speaking of the morning, remember to join me and Brent Moores for Trader Talk at the opening bell tomorrow, bright and early, 9:30 a.m. Eastern. We look forward to seeing you then. So have a great evening. Catch up with you again real soon, everybody. Thanks.